So imagine waking up every single morning and just seeing your trading account grow. Not because you caught some lucky price spike, and definitely not because you're sweating over a risky second-by-second trade. Nope, simply because you are earning interest while you sleep. Welcome to this explainer. Today, we're going to unpack the unseen mechanics of the global foreign exchange market, which, by the way, is a $6.5 trillion a day machine. We're looking at the hidden forces that drive massive wealth for individual traders and the giant institutions desperately trying to keep the whole thing from spinning completely out of control.
All right, here is our roadmap for how we're going to cover this. We'll start with the Forex profit engine, move into when carry trades collapse, then look at taming the currency chaos, how BRICS banks intervene, and finally, wrap it up with the Global Balancing Act. Okay, let's dive right into Section 1, the Forex profit engine. You know, while most traders are obsessing over buying low and selling high, there's this strategy called the carry trade that plays a completely different game. It's basically a strategy where you borrow money in a currency that has a really low interest rate, and you turn around and invest it in a currency with a high interest rate. You are essentially acting like your own little bank, just capturing the spread between two entirely different economies. And honestly, the best part for traders, when you hold these positions open overnight in the Forex market, you actually earn this interest rate differential. It just gets credited directly to your trading account every single day. Let's look at a real-world example to make this crystal clear. Think of it exactly like taking out a business loan. Imagine you could borrow Japanese yen. Historically, the Bank of Japan has kept borrowing costs incredibly low, like near zero, let's say 0.1%. So you take that virtually free money, convert it in the foreign exchange market, and invest it in an economy like Australia, where the Reserve Bank might have rates set around, say, 4.5%. You are deliberately borrowing low to invest high. So do the math, right? By paying 0.1% on your borrowed yen and earning 4.5% on your Australian dollars, you just pocket a 4.4% annual profit. And that differential is yours simply for keeping the position open. Now, if you use leverage, which, let's face it, a lot of Forex traders do, that 4.4% can multiply into something massive. It sounds like literal free money, but there is a huge catch. This entire strategy absolutely relies on the exchange rate staying completely stable, because if the Australian dollar suddenly drops in value against the yen, your capital losses will instantly wipe out all that nice steady interest you've been collecting.
Which brings us to Section 2, when carry trades collapse.
So this strategy, it is brilliant when investors are feeling brave. But when fear creeps into the market, things break fast. Look back at the early 2000s. The yen carry trade was absolutely booming. Traders everywhere were borrowing mountains of cheap yen to buy up higher-yielding currencies like the US dollar and the British pound. But then, the 2008 global financial crisis hit. Total panic just swept through the global markets. Traders desperately rushed to unwind their trades, and to do that, they had to quickly sell off their high-yielding currencies and buy back the Japanese yen to repay those massive loans. This sudden, frantic demand caused the yen to violently surge in value. We're talking about a staggering 30% drop in the USD-JPY exchange rate in just a few months. Billions of dollars in carry trade profits, poof, wiped out in a matter of days. So you have to ask yourself, when a financial avalanche like that happens, who actually manages this chaotic volatility? Who steps in when retail traders and institutional investors are getting wiped out in the blink of an eye? Because a 30% swing in a currency isn't just a bad day at the office for a trader, it's a catastrophic event for a country's entire economy. Imports suddenly become unaffordable, and inflation can just skyrocket. Let's look at Section 3, taming the currency chaos. To figure this out, we need to zoom way out from the individual trader's desk and step into the macroeconomic control room. Look at the BRICS nations for a second. Brazil, Russia, India, China, and South Africa. These guys aren't just minor players. They represent roughly 23% of the world's entire GDP, over 42% of the global population, and 17% of global trade. Plus, they sit on massive piles of foreign exchange reserves. When global currencies start swinging wildly because of shifting capital flows or collapsing carry trades, it's these specific central banks that have both the financial firepower and the absolute necessity to step in. And they have to step in. They literally have no choice because excessive exchange rate volatility is dangerous. It's not just a minor blip on a pricing chart. For these massive emerging economies, it creates deep, systemic uncertainty. I mean, think about it. It completely deters foreign investment. No company is going to build a massive factory in a country where the local currency might lose half its value overnight, right? If left unchecked, this kind of volatility can trigger devastating currency crises. We saw it with Brazil's hyperinflation in the 1990s, or Russia in 1998, and then again in 2014. The central bank has to act as a shield to protect the real physical economy from these unseen, highly speculative forces in the global Forex market.
That takes us to Section 4, how BRICS banks intervene.
Now, how do they actually do it? It's not just some guy in a suit slamming a big red button. Central banks operate in two main arenas to defend their money. First, you have the spot market. This is all about immediate cash transactions. It's the central bank literally going in and buying or selling billions in foreign currency right on the spot to absorb market shocks. But there's also the derivatives market. This involves much more complex instruments with future settlements, things like non-deliverable forwards and Forex swaps. Central banks use these derivatives all the time to manage liquidity in the market without having to immediately drain their actual physical cash reserves. It's an incredibly sophisticated balancing act.
And this brings us to a really fascinating, myth-busting finding from recent academic research. Do these multi-billion-dollar interventions actually change the long-term destination of the exchange rate? Surprisingly, the data says no. But do they reduce the immediate volatility? Absolutely yes. The central bank rarely changes the ultimate destination of where the currency is heading, but they're incredibly effective at smoothing out the bumpy ride. They keep the markets functioning normally and prevent absolute panic. So think of them not as the driver steering the car, but as the shock absorbers keeping the wheels on the road.
Now, let's put this into a global context. We mentioned earlier that the global Forex market trades over $6.5 trillion daily. Compared to the absolute dominance of the US dollar, BRICS currencies make up a pretty small slice of that total daily pie. You got the Chinese yuan at 4.1%, the Indian rupee at 1.7%, and so on. But here's the kicker. Despite their smaller global footprint, when these specific central banks target their interventions locally using the reserves, they are highly effective at absorbing those abrupt domestic shocks we were just talking about. Actually, it's not just direct central bank intervention that dictates whether a market is calm or chaotic. Broader economic risk plays a huge role too. Things like sovereign yield spreads, which basically measure the perceived risk of a country's government bonds compared to safe haven US bonds, also actively impact currency volatility. For example, the academic data shows that in countries like Brazil and Russia, as their sovereign yield spread shifts based on how investors are feeling, the volatility in their currency actively shifts right along with it. A higher risk premium can trigger capital flight, which makes the central bank's job even harder. It is all deeply interconnected.
All right, our final section, Section 5, the Global Balancing Act.
When you step back and put all these puzzle pieces together, the individual retail traders chasing carry trade profits, the massive sweeping shifts in global capital, and the central banks deploying billions across spot and derivative markets, you realize it's just this constant, never-ending tug-of-war. I think this is captured perfectly in a really powerful quote from the academic research we reviewed. It says, "An optimal exchange rate system is not an option, but rather a decision determined by the failure of previous systems to deliver stability." Just let that sink in for a second. Global financial stability isn't some natural, peaceful state of being. It is an ongoing, highly reactive, and fiercely fought battle by policymakers who are just constantly adapting to the crises and the failures of yesterday.
Which leaves us with a critical, final question to ponder today. We've seen how trillions of dollars flow silently around the globe, how traders seek profit in the interest rate gaps, and how massive central banks have to build these complex defensive walls against the chaos. Knowing all of this is happening right now, behind the scenes, how does your own domestic currency survive this $6.5 trillion daily tug-of-war? Thank you so much for joining me for this explainer. Keep learning, stay focused, and always question the unseen forces around you.